let us go straight to what the question requires us to do. Part A, it says calculate the consolidated profit or loss on disposal of sitting. So the information concerning sitting is in note number 3. So to calculate disposal of sitting, what we need is your fair value consideration received. Okay, this is your sales proceeds. Fair value consideration received. To that, you add the fair value of equity interest returned. Fair value of equity interest returned. Now, this is your investment that remains when you dispose an asset. Okay, these are your sales proceeds, and then you less the net asset and the goodwill at the date of disposal. The date of disposal. So we'll be given net assets and you calculate goodwill. So under note 3, the fair value, the sales proceeds was given as 23. The equity interest in investment that remained was 13, so that you have 36. The fair value net asset at the date of disposal was 36. So then goodwill we calculate, which is cash consideration of given in the note 39, and the fair value of net asset is 32, so that you've got 7. So that the loss, this minus this is 0, 0 minus 7 is minus 7. So we have a loss on disposal of minus 7. Okay. Now, sitting was a subsidiary, and because we disposed 6%, it returned from a subsidiary into an associate. So when we are computing goodwill, we are going to derecognize that goodwill. We are not going to add the goodwill in a balance sheet. Why? Because we've lost control. And the date of reporting and the date of disposal is the same. So we don't have post-acquisition profits. When you're looking at investment, now already investment there, we know that there's an impairment loss there of 3. 16 minus 13 is 3. So there are no post-acquisition profit. If disposal was months before preparation of a statement, if it was only 3 months, then we are going to have profits. Now in this case, disposal was at the date of when you're preparing financial statement. So let's look at question part B. Prepare the consolidated statement of Grange. And so we shall look at so many workings and make necessary adjustments. So let's look at fair value calculations and goodwill. From what number 1, fair value. So look at fair value adjustments. This is for your property, plant and equipment workings. Fair value adjustments for PAC. So what we need to do is we need to know when was the date of acquisition, okay, so that we know the period, which is the movement, and when are we preparing. So we are preparing on 31st November 20X9. Acquisition was on 31 June 20X8. So this period from June to November 2008-2009 is 1 year, 5 months. Okay. And in terms of fair values, we are told that there is land there. Fair value of land as 360. Okay. Now this is balances at the beginning. We need to know the balances at the beginning. Fair value is 360 and is due to non-depreciable land. If you lessen that with a book value, share capital, given in the question as 2/3 and not 1, your returned earnings was given as 115, and other components of equity was given as 10. So that this, when you add 230 plus minus 115, 230 plus 115 plus 10 will give you 355. Less 360 will give you 5. So that is your land, which does not depreciate, non-depreciable land. So at the end, it is 5. Now, this is what goes to your property, plant and equipment. You add 5 there. Then we also told that under note paragraph 2 that there is a franchise right, an intangible asset there of 10. Okay, an intangible asset of 10, and this is depreciating over 5 years. So in terms of depreciation, if we say multiply by the period is 1.5 over 5 years. There 1, there 2, 2 times 1.5 is 3. Okay, so that the depreciation is 3. Intangible assets at the end will be 10. Okay. So this format, this is what goes in your retained earnings when you're doing your fair value adjustment minus 3. Okay, and then 7 is your intangible assets, franchise right, and 5 goes to property and equipment. Okay, 10 you add to your goodwill calculation. Okay, fair value adjustment in pack under note 1. Then we are going to have fair value adjustment under note 2. Fair value adjustments for fence. Same thing at acquisition. This was acquired at 31st July. Okay, 31st July 20x8. So we want to know the movements of the period. Then the year end, we are reporting this at 31st. At 30 November 20x. Now this is a period of 1 year, 4 months. Okay, and what we have in terms of fair values, we are going to have we said we have a contingent liability under note number 2. We have a contingent liability which at the beginning it was 8. Now a liability is a minus. Then it met the condition of IAS 37. At the end it was reduced to 25. Now a reduction in liability is the gain, so there's a gain there of 5. Okay, and then under note number 2, paragraph 2, we are told there that there's a valuation gain on property of 4. Okay, valuation gain on property of 4, and this is depreciating over a period of 10 years. So this period, 31st August to 8 November is only 4 months. In terms of months, it's 1 year, 12 plus 4 is 16. Over 10 years, 10 times 12 is 120. So that when you say 4 multiply by 16 over 120, in terms of depreciation, it's 0.53. 16 over 120, multiply that by 4, by 0.53. Okay, that is your depreciation of property and equipment. So that we have 4.47 there, and this we have 3.47. So that when you subtract that, between 1.53. Okay, and this is minus 26. So this is what goes in your retained earnings under fair value adjustments for pack for sitting. And then 3.4 you add to property and equipment, and then this figure, you need this figure when you're computing the increase in non-controlling interest. When you're disposing 25% franchise, we are going to, like what to do in an impairment review. That 25%, we are going to say net asset. We are going to say net asset per question. Okay, net asset per question for franchise, which in the note is given as 232. Then we shall add this 21.53, less than the goodwill, which we calculated earlier as 8. So that when you add that 232 minus 21.53 plus 8, 218.47. You multiply this by the 25% the disposal. Okay, then you lessen from the cash consideration. Okay, and the cash consideration was given there as 80, which is debited. So that when you lessen 25% of 218 multiplied by 25, 54.6 2 minus 8, 25.38. So you credit, you're going to credit non-controlling interest when you come to non-controlling interest. Debit cash, non-controlling interest, and equity. Now this working you need to master. So I'm just trying to remind you in class the use of this 21.53, and those are changes, calculating changes in non-controlling interest. We'll come back to it when we do the returned earnings. We shall revise it. We'll come back to this. Just want to remind you that we need this 21.53. Okay, let's look at the rest of the notes. Note number 4. Note number 4 says Grange acquired a plot of land on 1st December 2008 in the area where the land is expected to be significant in value. If plans for regeneration go ahead, the land is currently at a cost of 6 million in property, plant, and equipment until Grange decides what should be done with the land. The market value of now land that is held for use is under IS 40 is the investment property. So for entry for that 6, you debit the investment property with 6 and the credit property, plant, and equipment with 6. So 6 you subtract in the property, plant, and equipment. Now under the last note, there's a lot of irrelevant information there, but that note says that the company uses the return on capital employed to maximize profit. Therefore, we are going to use the fair value model to evaluate the land. Okay, so we know that there is a valuation gain there of land of 8 minus 6, the market value being 8, and the current market, the current cost is 6. So there's a valuation gain of 2, which we shall need when you're computing the impairments or when there's a restructuring. Okay, then the further note says the market value of the land at 1st November 2008 was 8, but at 1st December it was reduced to 7 million as this. There was some uncertainty surrounding the viability for the regeneration plan. Now that 7 is a non-adjusting event. We're not going to look at that. So then note number 4, let's look at note number 5. Grange expects that it will be fined 1 million for the local regulation for environmental pollution, and it also anticipates that it will have to pay compensation to local residents of 6 million. Now that is what a present obligation rising from the past events. I mean, there is an environmental provision there of 1 plus 6, so 7 is your provision. Okay, and it says that in addition, the regulator has requested that certain changes be made to the manufacturing process in order to make the process environmentally friendly. Now, this is anticipated to cost the company 4 million. Now, for that 4 million, there's no provision. Okay, certain changes can be made. There are so many other changes that you can do. You can just shut down. You can get better equipments. So that 4 million, do not make a provision for that 4. So the only provision is 1 plus 6. Okay, then note number 6. Grange property located in foreign country, which was acquired at the cost of 8 million dinars on 30 November 20X9 when exchange rate was $1 to 2 dinars. So you have a property held in a foreign country or is foreign currency. We need to convert that into our home currency. The exchange rate there is $1 is equal to 2 dinars at the beginning. So we will say 8, divide that, to convert into home currency, divide that by 2, so that we are going to have 4 at 1st November. Then we have got 8 million, 12 million dinars, 12 million dinars, exchange rate $1 is equal to 1.5. Now 12 divided by 1.5 is 8. Now from 4 to 8, there's a valuation gain there of how much? Of 4. Okay, so evaluation on property is 4. Okay, that's your note number 6. The note number 7. Grange is prepared to plan for reorganizing the parent company owned operation. The board of directors has discussed the plan, but further work has to be carried out before they can approve it. However, Grange has made a public announcement as regards the reorganization and wishes to make a reorganization provision on 8 November 20X9 of 30 million. The plan will generate cost saving. The directors have calculated the value in use of net assets of the parent being 870 million. If the reorganization takes place, and 830 if the reorganization does not take place. So what we do there is we carry out an impairment test. Okay. Now there's no provision there. Why? Because there's no constructive obligation. Now for you to make a provision, there must be a formal plan, and there must be an announcement that must be communicated to those that are affected. So for that, we are going to do a restructuring, and we will take into account the devaluations and any impairments. Okay, so devaluation, impairment review, we look at net assets. Okay, net asset equation is given in the question as 862. You get that in the balance sheet. Okay, so the net asset 866. Then you look at the evaluation of investment property and the evaluation of property. The impairment also. What you want to is calculate the impairment which you add to your property, plants and equipment. So the net asset per question, in the question, net assets, so restructuring, okay, impairment review. We say no provision. For provision to be made, there must be a formal plan, and there must be an announcement to those that are concerned. Okay, so basically, what we are doing is we are doing impairment review. So that net asset per question is given in the balance sheet. There is 862. And then we have an evaluation of investment properties. Remember, the market value is 8, current cost is 6, so the evaluation on property is 2. Okay, then we have given an environmental provision of 1 plus 6, which was 7. Okay, we want to do carry out an impairment. Then we have evaluation of property, investment property, and then we had the evaluation again on property, plant and equipment, which was given as 4, and when we do an exchange rate there, home currency, we found that it was 4. And then you remember, investment that remained was 13. In the balance sheet, it's given as 13. So we have an impairment of in sitting, okay, which is 16 minus 3, 13, which is 3. Okay, so that when we add 862 plus 2 minus 7 plus 4 plus 3 should give us how much? 862 plus 2 minus 7 plus 850 impairment. 858. Okay, if the reorganization does not take place, we lessen as 830, that is 28. So we have got an impairment of 28. This you subtract in the property, plant and equipment, and you also take note of this 28 when you're doing your retained earnings. Okay, so let's look at so we have for workings for property, plant and equipment. We've done equating to 28. Remember the 6, remember the 5, and the 4.7. You add that, you adjust to the given amounts in property, plant and equipment. Okay, we shall look at when you're preparing the balance sheet, the consolidated statement. Okay, let's look at, did you calculate goodwill? Goodwill. Did you calculate goodwill? Okay. I think we didn't do that working to goodwill calculation. Goodwill in Grange, goodwill in park, fence, and sitting. So to calculate goodwill, it is consideration Then the fair value of non-controlling interest, fair value of non-controlling interest at fair value, of course. Then fair values of net assets. Now, consideration for PAC was given as 250. The fair value, remember, was 150. There it's 400. Okay, then fair value of net asset, remember, it's 360. We lessen so that we are going to have 40. Then you have fair value of net asset, purchase right was 10. So that goodwill is that fair value at the beginning. And then consideration for fence is given as 214. There is no non-controlling interest there. It's not given. You're using a full goodwill method. Okay, so no need for you to start calculating non-controlling interest if you're not given. Under full goodwill, normally will be given. So that we have 214, and then fair value net asset is 202. Then remember that we've got a fair value gain of 4. That is not part of 202. So we need to add that so that 2 plus 4 is 6 minus 14. We have 8. So that goodwill is 30 plus 8, which is 28. And then remember we had calculated goodwill in sitting when we are doing a disposal of sitting. Fair value consideration was given us at 9, and then fair value net asset was given us 32. So that goodwill is 7. Now this 7 is de-recognized. Okay, we're going to have 0 there. Why? Because we've lost control. Okay, that is goodwill calculation. So quickly, let's look at retained earnings. Okay, just from before goodwill, we did a calculation for restructuring. Okay, so if you remember what goes in the restructuring, those figures, provisions, impairment, we calculated an impairment of 28. It goes also in the retained earnings. So retained earnings, say per question, Grange, PAC, fence and sitting. Now per question, we are given per question retained earnings per question. Let's see what is in the balance sheet. The balance sheet is 410, and for PAC it's 170, and for fence it is 65. Now you don't need, this is already the group share. What goes to group share was already given in the note number 3, as it was given as 3. Okay, the same for when you come to other component of equity. Under sitting, we are given 1 million. It was going to other component of equity. Okay, so no need for you to calculate the figure there for our group share. Then we say loss on disposal. The question, loss on disposal of sitting. Loss on disposal of sitting was 7. Then we have the fair value. We need to do fair value adjustments. Now for PAC, it was -3, and for fence it was 4.2. That was 4.47. Okay, 4.47. So fair values. Then gain on investment of property was given as remember in the restructuring we said gain on investment property is 8 minus 2, which is 2. Then we had the environmental provision of 1 plus 6, which was 7. Okay. Then we have an impairment which we calculated in the restructuring. Impairment there was 28. So that your pre-acquisitions given in note 1 for PAC is 115. And then for fence, the pre-acquisition was it 73? Note number 2. Note number 2, retained earnings for fence was 73, and other components, okay, 73. So that 170 minus 3 minus 115 will give you 52. And 65 plus 4.7 minus 73 should give you a negative what? 65 plus 4.47 minus 73 will give you minus 3.53. So that your group share there for PAC, for fence, and for sitting. For sitting, we are told is 3. Let me there it's minus 3.53, multiply this by the percentage holding there at the beginning. Acquisition 100%, this was 6%, so multiply this by 100%, this by 100%, and after 2 you multiply by 6%, so that this is 3, that one is 3.53, and after 2 multiply by 60 gives you at 1.2. So that's your workings for return earnings. So that when you add 410 minus 7 plus 2 minus 7 plus payment minus 28 1.2 plus 3.57, so gives you 400.7. 100 half is supposed to be 400.67. That's your returned earnings. Now take note of this, because when you're doing your returns non-controlling interest, you combine returned earnings and the other components of equity. So we need this 52. Take note of this 52. Let's look at the other components of equity and the non-controlling interest. Okay, this is where you need to master the workings for changes in the non-controlling interests. It is in the other components of equity and the non-controlling interests where we make those necessary adjustments. So let's look at the other components of equity. Other components of equity are the components of equity. Okay, in Grange, back, fence, and the sitting. So other components per question is given as other components of equity. For Grange is 22, this per question 22, 14, and 65. Remember, one was already given. Then we had a devaluation of property. That was 8. Evaluation of property. There's investment property, and there's that valuation of property which was a note 2, and I think which is the same as property of foreign currency. So the valuation of property was 4. Okay. Then pre-acquisition profits, you find this in the notes. For PAC, under note number 1, it's given as 10, and in fence it's given as 9. Okay, 22, 14, and 17. So that this would be 4, and this would be 8. So that your group share for PAC, for fence, and for sitting. For sitting, it was 1, it was given a note, that is 8, 4. Multiply this by 60, multiply by 100, multiply by 100. So that this you're going to have 1, this you're going to have 8, and 4% multiply that by 60. 60 multiplied by 4, you're going to have 2.4. And then there, you need to pay attention. What goes to your the changes in non-controlling interest. Changes in non-controlling interest for PAC and for fence. Now, we are given consideration when we're disposing equity interest there. For a cash consideration was given there as 80, and the under fence, the cash consideration was given as 80, okay, and the under part was given as 90. So what do we do now? Well, we say the decrease in non-controlling interest, 20% over 40 of the non-controlling interest. So we need workings for non-controlling interest. Okay, this is working. Was it working number? I don't know. 6, working 7 or so. So non-controlling interest. So non-controlling interest, park, fence, and sitting. Not per question, but per acquisition. Per acquisition. Remember the non-controlling interest when we're calculating goodwill in park was 1/5. Then there was nothing for sitting and defense. Okay, to non-controlling interest, we combine the other components of equity and the retained earnings. Other components of equity, so non-controlling interest, other components of equity, retained earnings, other components of equity. Okay, so remember that 52 that I was talking about in retained earnings. Okay, we had 60%. This time we're going to have 40%. Then the other components of equity already there is 4. So where we had for PAC, where we had 60%, this time we're going to we had 60%. This time we're going to have 40% non-controlling interest. 40%. Okay, so that 52 multiplied by 40 gives you 20.8. 20.8, and the 4 non-controlling interest, multiply that by 40%, 1.6. Okay, so that when you add this figure, 20% of non-controlling interest, that's what we want here. 20%, an increase, 20 over. Now remember, at the beginning, 60% acquisition, then we added 20, we had 80. So this increase is 20 over 40. Okay, this is a decrease rather, decrease in non-controlling interest. Non-controlling interest here is 40. Non-controlling interest here is 20. So it's 20 over 40. Okay, of the non-controlling interest. So this figure here, 150 plus 20.8 plus 1.6, 172.4. 172.4. So 20, half of 172.4 gives you 86.2. So that is what you have there. The cash consideration when we are disposed not number 1. We are given that not disposal but acquiring. Grange acquired a further 20% interest from non-controlling interest for a cash consideration of 90. So it's 90. Then you've calculated this as 86.2. Okay, so that the entries. The entries for that will be debit in non-controlling interest with the debit non-controlling interest with the what's the difference? 90 minus 86 minus 2 minus 90. That's 3.8. Okay, so this one goes to equity. Credit debit equity with it 3.8, and we credit. We are going to credit cash. The cash there was cash consideration of 90. So the difference 8.62 goes to non-controlling interest for PAC. 8.62. Debit non-controlling interest there. Now this is half of that, so you remain with the 6.2. Okay, so that is when you acquire 20%. When you acquire 20%, there is a decrease in non-controlling interest. Then what about fence? For fence, when we had acquired 25%, not number 2. On November 20, Grange disposed 25%. It's not acquiring but disposal. 25% of equity interest in fence. Non-controlling interest cash consideration was 80. So disposal of net asset. For that one, what we're going to do is something I mentioned this area. So net asset, fair value adjustment for at the end for fence, and then goodwill. Okay. So goodwill is 8, and the fair value was 21.5 what? It was 21.53. The net asset for fence in the question is given as 232. So that 232 you lessen 21.53 plus 8, you have 218.47. To this, multiply 25%. So that you're going to have 54. Cash consideration is 80 minus 54.6. You acquired 25%. So the difference, these are your changes in non-controlling interest. 25.38. So these two workings, make sure that you master these changes in non-controlling interest. So the 20%, this is the decrease in non-controlling interest, 20% of non-controlling interest, 172. Okay, and then the difference you subtract with the cash consideration 90, then you make the necessary entries. And this one is more like an impairment. Given net asset, then fair value adjustment, add goodwill, multiply 25% less the cash consideration. Okay, those two workings are very important. You need to master these two. This is what this question is all about. It's calculating changes in non-controlling interest. Okay. So then you credit what? You credit fence with the 54.6. So this is your non-controlling interest, this plus that. So the total here now for Grange and other components of equity will give you, if we add 22 plus 4 plus 3.8, it is a minus, 3.8, 22 plus 4 plus 3.8 plus 25.38 plus 2.4 plus 8 plus 1. We have 58.98. Okay, that is all for our workings. We have done all the workings. All we are remaining with now is your consolidated statement, which under strategic business analysis, they are omitting. They are not asking you to prepare the whole statement, but under P2, they were asking. Now for ZiCA, you need to prepare the full statement. Okay, so we have already done the calculation. It's just a matter of saying how does it look like. So there's a lot of math, I'm sure, for working if you're doing strategic business analysis. Now in the 2021 Rev Kit, this question is not there, but it's a good question for practice. Okay. So what we are remaining now with is a preparation of consolidated statement. Grange Group consolidated statement as at 30 November 20X9. Non-current asset. Okay, property, plant and equipment. You get the given amounts. Okay. And the question, what are the given amounts? Question 52. The given amounts, property, plant and equipment is 257 plus 311 plus 238. Remember, fair value adjustment, we had 5 for pack, that was working 1, and then we had 3.47, okay, fence, and then remember that the land which was set for investment, we paid the property and equipment 6, then the valuation gain of 4 less impairment 28. Okay, so that when you add this should give you how much? If you use the calculator, 257, 311, 258 plus 5 plus 3.47 and 6 plus 4 minus 28. You're going to get 484.47. 484.47. Okay, property and part equipment. To that, we are going to have investment property. Remember the investment property. Investment property, the current market value was 6, and then a devaluation gain of 2, 8. Then remember goodwill. Goodwill was 30 plus 8, which was 88. Then remember we had intangible assets. Okay, intangible assets, which was 7, franchise right. Then we have investment property, investments in associate or sitting. You have become an associate from 16 to 13. The final figure is 13. So that when you add that, it should give you 784. 74.47 plus 8 plus 38 plus 7 plus 13. This gives you 850.47. 850.47 is 47. To that, you have current assets. Now, under current assets, there's no adjustment. Perhaps that's why strategy-based analysis is not asking us to prepare all that, because these are free marks. We're given 475 current assets, 304 and 141. So that when you add the total, it should give you 4, 5, 6, 7, 8 plus 9. It would be 900 and 1. This is 6. This is 1 plus 4. Or 5, 10. 4, 5, 2, 4 plus 4, 8, 9. It should give you 920. Okay, those are your current assets. So that current asset plus those, we're going to have 4, 7, 8, 7, 8, 16, 17. Okay, this is 1770.47. Then we say equity attributable to owners of the parent. Equity attributable to owners of parents. Owners of parents. Who are owners of parents? Rent parents. Rent parents. Okay, share capital. Share capital. Return earnings already calculated. Other components of equity. Now, share capital, you get that in the question. And share capital in the question was given as 430. Returned earnings of already calculated. Remember, it was 400.47. And other components of equity was 58.98. We calculated that at 58.98. So that to this we add a non-controlling interest, which we computed. So if we say 430 plus 400.47 plus 58.98 it gives you 889.47. Again, before 7. 889.47. And then with the non-controlling interest, remember we calculated as 140. Non-controlling interest 140. That was 140.82. Okay. So that when you add those two, it should give you 889.65 plus 140.83. 1030.1030.4848. Okay. Is it 8 plus 3? Yeah, non-controlling interest. Then to that we have current non-current liabilities. Okay. Non-controlling interest, non-current liabilities. In the question, it's given as no adjustments there. 172 plus 124. 172 plus 124. To that you add 38 plus 38. So this gives you 172 plus 124 plus 38. It gives you 354. 178 plus 70. Non-current liabilities. 172 plus 124 plus 38. 172 plus 124 plus 38. 334. 178 plus 124 plus 10 plus 38 gives you 334. Okay. Am I tired or what? What else do we have? We have current liabilities now. Current liabilities, and then trade, and then payables. Remember provisions. Current liabilities. Current liabilities is 178. 178 plus 71 plus 105. The total should give you let me just say 354.0. Then provision, what is in the question is 10 plus, in the balance sheet, 10 plus 6 plus 4. Environmental provision 7, and the contingent liability at the end 25. So that should give you 50. 10 plus 6 is 10 plus 10, 20. 20 plus 7 plus 25 is 52. Okay. So that when you add everything, let me just add everything. You can cross a boundary there, but what you want is total liabilities 0.48 plus 334 plus 345 plus 52 gives you 1770.48. 0.47, 0.48. Anyway, that is due to round off. There's just a difference of 1. Okay, so this is your consolidated statement. So we said how many minutes? 50 marks. Okay, that's all. This you're supposed to answer in 45 minutes. This already is 50 minutes. Okay. Shall look at another question, probably a ZiCA question.